I'm with Peter Norris and Andrew Mackay from Squirrel. Hi, guys.
G'day. Good morning, good afternoon, good evening.
Good morning. Well, it's morning where I am. I'm calling you from Tokyo. About lunchtime in Auckland, isn't it?
Yep.
Midday.
Wonderful. Which is why this will be very intentional,
This,
as we're
yeah,
both very hungry.
yeah, getting hangry. So you see the guys are wearing the Squirrel corporate suits, so they're clearly in the higher ranks of the brokerage there. Why don't you give me a background? I'll give the guys a bit of a background into who you are and where you're from before we dig into today's topic.
Go. Who we are?
Yeah, who are you? So
How we get
why should
squirrel.
we're going to talk about mortgages, and why should the guys listen to Andrew and Peter?
Oh, okay. So my name's Andrew Mackay. Been in the game a long time. My father did 40 years banking, so we talked about that at the dinner table. I've done 5 years BNZ, a few years of mortgage broking, and then a couple of years with Peter in business. And then we sold our business into Squirrel, which was, coming up 2 years, in very round numbers. And yeah, I've been through probably 2 or 3 property cycles when lending's easy. So I've seen banks doing 120%, all the way through to when we're in a tightened credit market. And this is currently kind of where we're at, with even governments interfering with how banks lend, which is a very interesting space. My specialty is probably more investors, first investors, seasoned investors, housing under construction, and I dabble in a bit of business stuff. Self-employed. A lot of Kiwis are. So, yeah, over to you, Peter.
Yes, so I was BNZ 5 years, and then that's where Andrew and I met, and then same as Andrew, owned a business, sold the business to Squirrel, now run the Takapuna team, and specialise in dealing with sort of the bigger stuff, the property investors, the bigger portfolios, development type funding, construction, all that sort of stuff. And I write in the New Zealand Property Investment Magazine on a monthly basis as well. So, a bit about me.
Great stuff. So the reason I asked you blokes to jump on a call is just what on earth is happening in the mortgage market, because it feels like the game has completely changed very, very fast. And we're seeing a lot of our clients get caught out where they get all excited about a property and then all of a sudden the bank says, whoops, no, sorry. That was how it worked before Christmas, but it's not how it works now. So maybe you could just start to shed some light on just what's going on.
Yeah, so the biggest hurdle that we're facing at the moment is really bank interpretation. So you've got the Reserve Bank policies that have been brought out. Those are obviously things that people know about. So you've got the LVR changes, 60%, 80%. You got the overseas income stuff that the Reserve Bank's brought out, which has been in the media. That's what people know about. That's what people understand. But then what you've got in the background is you've got bank credit policy changing, and every bank's changing credit policy slightly differently. You've got test rates in terms of how the banks, the rate at which they assess the loans is vastly different across the banks, whereas historically they've all been pretty much there or thereabouts. You've got credit policy and bank appetite very different across all the banks. So you can walk into one bank and get a yes and walk into another bank and get a no, or vice versa. Whereas again, historically, pretty much banks have been much of muchness. There might have been 0.1, 0.2 difference in rates, but for the better part, they've been pretty similar. So with that, you've got, and the credit policy stuff that's changing is not stuff that's out in the media. It's not stuff that clients know about. It's not stuff that we're forever having to battle about what we know and what we don't know, because it's changing so often. As you say, a deal that was approvable 4 months ago today is maybe not. You've got banks' ability to lend, so for off the plan construction type deals where historically people have been able to buy an apartment off the plans that's 2 years away from being completed. Now can't do that with absolute confidence, because banks are only approving for 60 days or 90 days, some for 12 months, but no one for more than 12 months. So if you buy something off the plans, which is sitting in 2 years, you don't have 100% certainty that that bank in 2 years' time is going to still approve that loan, which is leading to buyers, I guess, being a lot less confident to go in and actually buy those off the plans, which is leading to developers not getting enough pre-sales, which is meaning developments aren't getting off the ground.
Which is giving the government a big headache.
Yeah.
So we'll dive into that point just a little bit. Do you think there will be any, and I've seen some articles in the media about this, that there's going to need to be some government intervention into this tension between what the banks are willing to lend on and what the developers need people to get lending on in order to do their projects? Do you see any intervention coming from the government to reassure one side, prop up one side or the other to make sure these move ahead, because the government needs more houses?
That's the easy answer, because Peter and I were talking about this the other day. It's like, at the moment, we've got sale and purchase agreements that support the developer, which is what the bank's actually banking on. Now, even though the contract's legally binding to the purchaser, it doesn't actually mean that they can fulfill on that contract because the banks keep changing the goalposts. So there's actually a risk, and it's full circle, right? So the banks aren't at risk with the client, but they are at risk at the other end, which is the developer tipping over. So that's why the only person that can step in is the government, unless the banks figure it out. Peter and I are also talking about what's happened in Sydney with foreign income, meaning that a whole lot of sales have just or funding for the sales to complete have all fallen over, which equated to like 20,000 apartments, I think was the number. And that is literally something that hopefully the housing minister is looking at.
Yeah.
But it's the only way, because the banks, again, then the other issue with that happening is that's impacted over in Australia, which is where our banks operate from. So then do they take that lesson and make the changes here themselves, or do they take that hit in Australia and actually keep us quite constrained from a funding point of view?
So let's dive into that next, because that's an interesting point. And I think folks understand at a very high level that the banks are owned primarily from Australia, and excuse me, that any issues on the credit side in Australia due to economic instability or policy changes that are affecting the developers over here, which affect the banks over there, are going to flow through to us. And it seems that they are flowing through to us. How much of what you see happening now in the New Zealand side is due to the economic situation in the bigger cities in Australia, and the mining industry as well?
At the end of the day, the credit policy, the changes that are happening, whilst they're New Zealand based in terms of the changes, they're Australian-owned banks that are making changes. Credit policies will be somewhat impacted by things that are happening over there. At the end of the day, I think there are decisions being made over here that are reliant on the New Zealand economy as much as the Australian. The interesting point on the whether or not the government, just going back to the government intervention side of things, is whether or not they actually need to. I'd say there probably is something around that, and it would need to be, in my opinion, something specifically around the construction, and maybe loosening off the rules around LVRs and that sort of stuff for construction type funding. I mean, you've got a development, for example, out in South Auckland, which is 580 what I would call as affordable houses being built out there, where exactly the same thing that I was talking about before. Off the plans, clients aren't confident enough to buy, which means the developers can't get the pre-sales, which means you've got 580 odd houses which are struggling to get the sales they need to get the development actually done in the city where we need more houses. So, I think government intervention is likely, but then again, bank policy changes on a daily basis.
Right.
They come in and come out as quickly. So
I'll ask it's probably a dumb question for someone who's not in the industry, but don't we have banks that are not Australian owned, like just New Zealand focused, say Kiwi Bank? I'm not sure if TSB still counts as a Kiwi owned bank. That's how they market themselves. Are their policies and rules changing aligned with the big four, so to speak, or have they got different issues they're dealing with?
The credit policies are as I said, the credit policy changes that are coming across the banks aren't actually. It's not so much one bank does it, all the rest of them follow at the moment. It's one bank does it, and the rest of them kind of do their own thing.
Right.
So you have the likes of TSB, your SBS, your Kiwi Bank are still making credit policy changes, but they're a lot smaller. They're a lot less. Kiwi Bank, for example, won't lend over 85% at the moment. So that causes a little bit of an issue. TSB, whilst they can do over 80%, because they're so small, their 5% allocation actually only equates to $5 million that they can lend over 80%. So in a very short space of time each month, that disappears. So yes, credit policy changes are still happening within those banks, but they're so much smaller than the bigger players, I guess.
Right, so it's not having a real impact on the bigger projects.
No.
So, to summarise, the banks are interpreting the recent RBNZ changes in their own way, and this is, I think, where the confusion is happening, is that we, the market, and the investors and whoever, we know what the RBNZ rules are at a high level. Here's your LVRs, here's how servicing is calculated, and as you said, up until probably 6 months ago, you could be reasonably sure if you walked into the door of Bank A and they were happy with what you offered, that you could walk down the road to Bank B and Bank C. And they would probably line up to bid on your business. But it's almost the opposite now, whereas you're being treated as such a potentially high risk. And they're all, because of, depending on where they're based and what's happening on the home front, or the size of their portfolios, or what they've got on their books, battening down the hatches in some way, but each way is a little bit different.
Yeah, exactly. Or a lot different. You've got a spread of, if you look purely at interest rates, again, for the majority of as long as I've been lending, the banks, you could pretty much guarantee that they would match each other on rates or be very close. At the moment, there's a spread across Bank A, Bank B. There could be 0.6 to 0.7% difference in what each bank is actually prepared to offer, simply because one bank's going, nah, you know what, I don't want to compete on price, don't really need the business, so I'm just not going to. Whereas Bank B is going, well, actually, I quite like some of the market share, so I'm going to pay for it. There's just not that same level of banks being prepared to compete on price. Some banks at the moment pretty much completely pulling out of the price war, not discounting on price, not discounting on rates, not giving any cash. Again, 6 months ago, cashbacks were hugely common and big numbers.
No, I got a cashback a while ago, and I just heard from someone else for more lending, same bank, nothing.
Yeah.
6 months.
Yeah.
So that's where we are. What do you guys, and it's always hard to look forward because everything changes so quickly, and it's an election year and there's all sorts of things happening. What do you think's coming up in the next 6 months? You first, Andrew.
This is being recorded, so we can get proven wrong or proven right.
You're an economist now, so toss a coin, mate. You could be a genius or a moron.
Well, I tell you what, it's the change is now constant. Getting borrowing used to be a right, whereas now it's a privilege, and that's going to keep. Yeah, and that's going to keep happening. We're noticing it at Squirrel. We're having record amount of leads coming through. We haven't changed things too much, but what it's kind of indicating is that the market is demanding more advice because it is that much harder. And even in with the office, I mean, we've got a team of 35 advisors where we can talk to each other and go, have you seen this? Is this changed? Like, we've got a level of uncertainty amongst ourselves because things are changing that quick, but we also have the skill to quickly, notice whatever's changed in the market, and then we can change to satisfy the client, basically. So that's only going to get harder because the houses still aren't being built. That's the issue.
Yep.
Yeah, and then test rates, that's the other thing. Test rates have all taken a big jump, so that means, as an investor, your numbers look very different to the bank's numbers, as they're, probably using double what you're using.
Yeah, it used to be 7% they would grade you on.
Yeah, so we call it 8 now.
Wow.
There's some slightly lower, but without divulging our IP.
That's okay. Yep, not a problem.
Yeah.
And the rise in interest rates. I mean, I guess from where I sit, and this is sort of jumping off from what's happening in the banking and just back to properties, is are you seeing that the increase in interest rates in the last 6 months has lowered off the amount of people coming to talk to you about properties, or increased, or it's about the same? No?
Nah, not at all. As Andrew said, we're still seeing record numbers of inquiry come in. We've got a lot of clients coming through, a lot of clients still looking to buy. At the end of the day, rates are still, whilst they went up a little bit over Christmas, they're still sharp, and you've still got banks willing to discount them pretty heavily back down to low fours, mid fours. So they're still really, really competitive rates. I don't see that changing anytime soon. The Reserve Bank's indicated that the OCR won't change until 2019. At the moment, any increase in rate is specifically driven by banks wanting to get more money to their shareholders. Really, the fact of the matter. You can spin that any way you want, offshore funding increases or whatever it is. But at the end of the day, one of the banks increased their floating rate a few weeks back by 0.15%, which added $250 million to their bottom line in the click of a button. So it's a shareholder profitability driven conversation at the moment around rate increases. I don't see that increasing too much further than it has in the near future, based on what the Reserve Bank's saying. So at the moment there's still plenty of inquiry around. The rates are still good.
So the banks are going to make as much money as they can without giving up market share, and that's the ongoing concern. Yeah. Well, that's it. Bank never loses, right? It's like the house at the casino.
Yeah. Well, if they're not making money, then they'll, they are a business partner to us, so they need to be profitable as well, because when they're profitable, then they've got more money to lend, and then that means you can buy houses, which then means you can make your money out of that, and it's just everybody's got to be happy, And I just still can't believe how low interest rates are. I've been in the game where I was fixing people at 9%, I don't think we're going to see that in the short term, obviously, but it's still loving these rates. For an investor, long and low. Whew, all good.
Yeah. Nice work. So, talking about investors, how can investors get ready and be able to buy in this market? So, I guess, how could an investor help you guys help them when they come to you with pre-approval or a property, etc.? So what are you telling clients to do at this stage?
So this is just clients coming to us?
I think in terms of pre-approvals and giving you the information about the properties they can buy. To give you some background to the question, is we as a brokerage, as an agency, we get a lot of clients come to us who thought they had equity and servicing, etc., to get finance. So they let a pre-approval lapse 8 months ago and hadn't bothered with it because, hey, they've only saved more money or their income's gone up, etc. And that's no longer the case. So people are missing out on properties. So what should an investor do right now to be able to buy in this market?
I'd be saying do your DD. It's a lot more. Investors need to be far more prepared now and actually have their sort of ducks in a row earlier than they have been before. I mean, days of going out and buying a property unconditionally and hoping for the best, really, you just can't do that right now. It's too uncertain as to what can and can't be done. Reserve Bank rules, but credit policy, all that sort of stuff dictates that we just need to be far more aware of what's going on and prepared.
Another thing would be, and I'm actually stealing Peter's client, but I heard him speaking of it, that Peter advised his client to do a part of the transaction first before he looked to do the second part of the transaction, so it would remain bankable. And by not following this advice meant that he literally lost out on what his whole intention was, which was to purchase another property. So he literally let that go, then listened to Peter again, get it in place, step one, step two. That's really important. The other thing that investors probably want to start considering is, and it's more popular in Australia, that the non-banks aren't the only banks. If you believe the market's still going to be bullish and you believe there's capital gains still to be had, then going to a non-bank lender where the interest rates are only slightly higher, like they're not even double digits like it used to be, that there are some safe options out there, because I think non-bank lenders or second-tier lenders have had a bad rap from the past, whereas now the market is far more regulated, that the non-bank lenders are regulated just as well as a bank, but they can get around a few of the rulings and things like that. So it's a lucrative option. If you can also see that possibly down the track you can end up having it back at main bank as well. But sometimes, some people, they get too attached to an interest rate that could be 1 or 1.5% higher, but they've forgotten that the whole goal is to not save money or make money from the bank. They make their money in the property, so you just cost of doing the deal. It's just a bit more of a shrewder approach. And again, it's because I've seen rates where they're 7.5s and 8s and 9s and people still buying property, and guess what? All those guys that I fixed at 9%, they're all wealthy because there was 2 cycles ago, right?
Yep.
So
their $300,000 property is now worth $1.2 million.
Exactly.
And what they had to pay in interest for the first 3 years?
Yeah.
Gone.
Yeah. Exactly.
It's a good point. So there's a few nuggets in there. Non-bank first. So are the non-banks able to lend above? Because let me step back. I heard that the likes of Reece Mccoy, etc., now have to be at the 60% LVR rule, same as other banks, unless you bring your home over to them.
Yeah, so that's not a ruling. That's just them making money, getting profitable.
Right.
Yeah. And that's the thing. It's like, I think your investors need to reflect on what the goals are. Then we look at the banks and go, right, well, this is how we can do it. So, example, I had a guy say today, he's on good income. He said, can I get 65% on an investment property? And I said, it's doable, but not straightforward. Right, which means you can get 60% out of a bank and then possibly look to use squirrel money at 5%.
Or somewhat.
And he's good.
Yep.
At least he's in.
Yep, 4 or 5%, not at 5%.
Yeah, for the 5%.
Oh yeah, sign me up for squirrel money, 5%. Let's do it.
Yeah. Interest rates at squirrel money are from 11% all the way up to, I don't know, I'll charge you 20.
Just because we're mates.
Just because we're mates.
But that's short term, right? I mean, I've done a deal in the past. One of my better purchases, I bought a property and I renovated it and added a chunk of equity. Now, if I bought that and I'd used 50 grand from squirrel money, I'd be able to come back to you after doing that renovation 6 months later and say, guys, here's my new registered valuation at this. Let's just move this over to a main bank and lock it in.
Sounds like a great plan.
Easy as, right? So are you seeing that with investors, that's a popular sort of 2-step process?
Yep, absolutely.
And you're still able to get these deals done quite smoothly. Are the banks open? I mean, I don't know if this is a don't ask, don't tell type question, but so how do the banks feel about us going off to the black market, which is where squirrel money clearly is, and getting some extra cash?
It's at the end of the day, as long as the debt's declared and as long as it's the client can service it.
Right.
It's that old responsible lending thing, right? If you can't put the client in a position where they can't afford it. So as long as the client's declaring that debt and that they can afford to have it, and that there's a clear exit strategy, then no issue there at all.
Yeah, because my understanding of some of these short-term lenders is that they don't want to be in the property for a 30-year mortgage, etc. They prefer an 18-month. Here's how here's the fee, here's the interest, here's how you're going to get out. You're able to do it. You're able to fund it. Great, sign off. So it's almost bridge lending in their minds.
Yeah, that's slightly different to what we're talking about around the squirrel money side of things. What you're talking about is more the non-bank sort of space where you might be doing a property trade or a quick in and out type deal or a bridging type finance where you're right, those lenders really only want to hang on to it for 6 to 12 months, make their money, get out, and move on to the next one. A lot of that happening.
And with that too, your investors need to do the numbers based on making sure that everybody's getting paid, so that then the deals keep getting done. Because if, as a mortgage broker or as the lender, if they're not making money in it, then they won't do it again. So it's kind of making it lucrative. They only make their money off the fee, to be fair, and the amount of work that it takes it takes something. So there's value that needs to be paid for and acknowledged, because I've had investors where, again, they're not focused on the goal, they're focused on the costs.
Yep.
And it's like, that's the price of a yes, so I've accepted your no. And it's kind of, it's to have been said in the space.
It must, the mind boggles, because I mean, a decent trade, or if you add 20% to the value of a property by doing something and you spent $500,000 on it, you've just made $100,000. Who cares? Sorry, if the broker or the bank or the lender, if there's $2,000 or $3,000 of fees tied up and that are extra just to get you your $100,000, that is tax-free, capital gain, cash flow, I don't know, whatever you're getting out of it.
Yeah.
It's not tax-free if you sell it.
Right, no. Well, and pay taxes. Hey.
Yeah.
So back to my original question. So with pre-approvals, my original question was what should investors be doing to prepare to be able to buy in this market? How important is having a good pre-approval in place now? Because I used to go put an offer in, get it accepted, and then I knew I could go to the bank and within 24 hours have a loan document.
The good old days.
Yeah, like last year.
Like I think right now having a pre-approval is more important than it has been in the past.
Yep.
Just simply so that you've got a little bit of bank commitment that should anything change over the next 60 to 90 days, you've got that pre-approval in place.
So we saw that was really important when the LVR change came in. There are a whole lot of pre-approvals out there that was bank commitment, and they had to honour them. So yeah, that kind of gives the weight to it. I think the first thing to do is get market ready. So it's like sometimes it is like if there was one bank that had the appetite for more investment or was testing at a better rate or what have you, sometimes the restructure, like what Peter was doing with his other client, restructure first, then get approval, then go and buy something, is always important.
So put your time in early before going out and hitting the market and getting all excited about a deal.
And also along the don't necessarily think that you can't do anything. It's easy to look at the numbers, and from a black and white point of view, look at the policy changes and go, nah, I can't do anything. It's not necessarily the case. There are, because there's so many different rules across so many different banks and non-banks, there are potentially ways of actually adding more property if you're creative as such. So it's worthwhile investigating if you're close to thinking you might be able to do something.
Because LVRs are different for a new build versus an existing home, are pre-approvals also different?
Sorry, ask that question again.
Because LVRs are different for a new build investment versus an existing house, if I come to you and say, look, I'd like to go out and buy this property, is my pre-approval different? So I've got a $100,000 deposit and I want to buy a $400,000 brand new apartment. I should be able to do that, but if it was an existing apartment, I wouldn't be able to do that. So how does that factor into what I need to communicate to you at the start so that you can go and line it up with a bank?
Yeah, so it's important to understand right from the start what exactly the goal is.
Yeah.
So that we do word that correctly. I mean, at the end of the day, if $100,000 deposit is not going to get you a rental property, an existing rental property, right?
Yeah.
But it get you a new build rental property. So the pre-approval, the wording is the same. It's just whether or not you can get one or not changes depending on how it's presented.
Okay. So listen to the investor from all of this is be really clear on what you're trying to do and go to your broker early and talk to them about the property in as much detail as you can.
Yeah.
In apartments, it's very important to know floor area. Very important.
Is it 40 square meters and above? That's the magic number?
50 is the magic. 40's a couple of the banks will do 40.
Right. Below that, it's 50% lending or no lending?
So below 40, you'll struggle. And 40 to 40 to 50, two of the banks will do normal lending criteria.
Right.
And 50 and above, they all will, apart from TSB. TSB is 70 square metres and above.
Okay. A little bit about foreign income and how people living in foreign countries, or Kiwis in foreign countries, because there seems to be about a few different criteria. You've got foreigners in foreign lands, Kiwis in foreign lands, Kiwis in Australia, that seems to be another one. And it's the same again. Folks who a year ago would have happily been able to just rock up to a bank and get an approval and go and buy a property, and now finding that depending on who they are, where their money comes from, or where they're from, or where they're living, the rules have changed again.
Yeah. So overseas self-employed income, no deal at all. Not possible to get an approval for that.
Nobody? Anybody?
Nobody.
Kiwi in Melbourne? No.
Kiwi in Melbourne, self-employed, no deal. Kiwi in Australia, or New Zealand resident in Australia, employed. Banks will typically use 90%, so they scale the income, convert it to New Zealand dollars, and then scale it. Right. Australia will scale it at 90%.
Yep.
So we'll use 90% of that gross income. Anywhere outside of Australia, and it gets scaled to 60%, so 40% drop. So converted to whatever the New Zealand equivalent is, drop to 60%. So that can have a pretty big impact on servicing.
Yeah.
Suddenly 100k income becomes 60k, and that makes a difference to a yes or a no. And then what if you got overseas? What is it costing you? How can you service that sort of stuff? So
yeah. So this is Kiwis in foreign countries. What about let's go to Australians next. So, or I don't know if they're lumped in with the other foreigners these days. What if you're not a non-New Zealand resident trying to buy here, but you're not in New Zealand? So someone from the UK, for example.
Yeah. So same rules apply?
Yeah. See, this is where we're like, what's changed lately?
Right.
Yeah.
But I tell you what I have noticed with regards to these questions is that they've a lot of them have left the market because they are finding it just that much harder. So a lot of them either have existing relationships, so they have gone direct, got an answer from a bank, and then they've just gone, oh, I can't do it, rather than engaging an advisor. And it's like, right, where are you banking? Because that matters. Then the next step, well, how can we get around it? What is your situation? And that's really where advice and understanding what they're up to, intention of visiting. Some people are like, well, we'll just come in. Whereas some people are like, we're not intending to come in. So it's a case by case, in my view.
It comes back to
case by case and moment by moment as the banks.
It comes back to how the client can be ID'd at the end of the day, or AML, Anti-Money Laundering Act, and whether or not they need to come into the country or not, and how they're going to do that. That's really where the banks. That's really what these rules are about, is anti-money laundering. So, like I had a case today actually where a client is a non-resident and or he's got a visa with conditions, and we've managed to get him lending, but it's just the deposit needed to be bigger. It needed to be 40% rather than 20%. So it's a bit more of a case by case and different bank by bank. So
yep.
The rules in terms of the self-employed versus employed and scaling of income and stuff are pretty black and white. But in terms of the actual overseas and what country you're from and where you live and how you're going to be ID'd is slightly different across each bank, because each bank has a different ability to do that. For example, ICBC have an ability to ID Chinese people a lot better than what BNZ do. HSBC are bigger again, so their ability to do stuff is easier. So yeah, it changes across banks.
What about deposit requirements, depending on who you are and where you're from and where you're living and what you're buying? And I guess what day of the month it is. Is that also changing? And this is anecdotally, I'm hearing clients are being told, oh, you need 40% for X because you're living here and you're buying this, and something else is the situation and it's bank B. Are you seeing any of those, I guess, a lack of consistency there?
Yep.
Yes.
Yeah, a little bit more case by case. Again, it comes back to that client I was talking about, right? As with a bigger deposit, it becomes a bit more possible to do. At the end of the day, they have to be employed. Wherever they are, they need to be employed, not on self-employed. And depending on where they're from, may change the deposit requirements, and depending on what they're buying, may change the deposit requirements. So, yeah. This is again why it comes back to doing your, getting your ducks in a row at the start rather than being a bit gun ho gun and buying something before you know what you can and can't do.
So, to try and bring this all into a cohesive sort of whole here, and this has been great, guys. Thanks for giving me half an hour of your time to jump around a few topics here. So just stop me if I've got any of these wrong. So the banks are now subjectively, depending on their internal situation or pressures or profit needs, subjectively applying the rules differently to clients in every bank, in every client situation. So there's more of a need now than ever before to come in and speak with an advisor and go out and have that person really understand you and then understand each of the different banks and be able to put something together that's going to work for you than there was before, because before there was a uniformity of how these rules would be applied. And for me as the investor, to now go out and get a good deal with decent criteria or conditions and know that I'm getting a competitive offer, I actually have to go to 6 or 7 different lenders one by one by one by one, and that's just not feasible. So the mortgage broking team is more of an ally and an asset than perhaps ever before.
Yep.
Yeah, 100%. Even if we don't, sometimes we don't even look to move the existing portfolio. But we need to engage that relationship with the bank direct, because then we can constantly negotiate best rates.
Yep.
The other thing too is if your advisor is operating on his own, he obviously does a level of deals that's a lot lower than us, so we start to see things a heck of a lot quicker, and we also get solution a heck of a lot quicker because we're all communicating it across the 35 odd advisors, rather than, banks can take between 5 to 10 days to get back to you. That then comes back to you. I mean, look, that's your finance clause done, whereas we can front foot a lot of those issues, because we're kind of already in front of the wave rather than behind the 8 ball, where I believe also some deals are possibly falling over or approaching the bank and getting the one no, and then maybe another bank. And it is disheartening, but if you've approached two banks that just aren't in the market, it doesn't even mean anything about you or your credit or your application. It just went to the wrong watering hole.
Yep.
Yeah. So, yeah, obviously, big advocate for groups of advisors, because you'll get sharper advice faster.
Well, they've got a sampling of the whole market, which I think now in a complex market is key. So get in touch with a broker soon and have a strategy.
Which is Andrew at Squirrel.
Andrew at squirrel.co.nz or Peter at squirrel.co.nz, and just talk to you guys before even getting interested in a property, because like you said, there was an example you had where basically the structuring and the strategy to even get ready to go out and put in an offer with that particular client, the way that they would have done it would have caused them to miss out on their next purchase. Back to the next thing. So guys, we're going to wrap this up now. Is there any sort of closing message you'd like to give to investors or people who are sort of seeing the market right now? They're a little bit nervous. They're hearing bad news coming out of the Australian property market. They're hearing interest rates, so they might be going up, that it's hard to get lending. What would you be telling these guys if you could sit down with them?
The first thing I would be saying to any investor is to trust your advisor. One of the biggest complaints as advisors we have is investors saying, "Have you heard from the bank?" because banks are taking longer, right? So you feel like nothing's being done when there's like silence for 3 to 5 days. But it's just how long it takes at the moment. And I guess it's just having that confidence in that things are progressing and getting done, and that the frustration isn't just the investors. For Peter and I, like we've been used to internal turnaround times where him and I could approve a deal in sort of 2 to 2.5 hours, whereas now we're pushed out to 5 to 7 days in some cases, and so that frustration is shared. But I would rather the bank took a little bit longer to give me a yes than turn around and give me a fast no.
Yeah, fair enough.
What about you,
Peter? Any closing words?
No, I think it's just a case of being patient. At the end of the day, the media are very good at putting negative spins on things. At the end of the day, that's their job. It's what sells papers or apps or whatever it is these days. It's a case of being patient, being a little more positive. There are ways in which to do things. There's ways in which to make the current rules actually work in your favour. There's still deals to be had, but it's really a case of surrounding yourself with the right people, with the right professionals, and getting that right advice, and then moving forward from there. And
it's the same for everybody in the market. I think it's important to throw that out there. It's not just you or me or someone else. By being the most proactive that you can be in getting prepared and being ready with an offer because you know what you can do, that'll turn around and give you an advantage in a market like this, because you'd be Johnny on the spot. Whereas a year ago you had to make a 3-day due diligence offer. These days, if you can make a 3 or 4 day due diligence offer and no one else can, you probably win the deal.
Yeah,
it's the new unconditional offer: 3 days due diligence.
yeah.
Okay, great. Thanks, guys. Appreciate it. Again, so Andrew at squirrel.co.nz, Peter at squirrel.co.nz. Thank you very much for your time, gentlemen. Talk to you soon.
Right, happy investing.